Have you noticed the seismic shifts in the financial landscape lately?
That's right. Today, we'll explore critical insights from top analysts like George Gammon and Chris Vermeulen.
We've harnessed AI technology to distill their expertise into digestible highlights, giving you the power to stay informed without the overwhelm.
So let's dive in. Up first, George Gammon reveals alarming signals from Warren Buffett that could alter your investment strategy.
And stay tuned for insights on auto layoffs and inflation reactions that you won't want to miss. Today, we're discussing Warren Buffett's unprecedented warning about the U.S. economy and stock market as analyzed by George Gammon.
According to Gammon, Buffett's current cash position is at its highest level since the global financial crisis, signaling potential trouble.
George Gammon points out that Warren Buffett has identified the stock market as being in a bubble.
Gammon reports that Buffett's actions, such as selling shares, indicate a strong belief that the market is overpriced.
Gammon emphasizes that Buffett's cash position is now 30% higher than during the last financial crisis.
This indicates a fearfulness about current market conditions, despite Buffett's stated preference for equities.
Gammon notes that recent layoffs at companies like Starbucks signal troubling trends in consumer demand.
According to him, these layoffs could contribute to reduced aggregate demand and further economic contraction.
George Gammon highlights that recent surveys show a sharp decline in consumer confidence.
This declining sentiment could indicate an upcoming recession and impact stock market performance.
Gammon anticipates that the market may face significant corrections if current economic trends persist.
He suggests that the data indicates an increasing probability of recession, especially in light of Buffett's warnings.
In conclusion, Gammon advises that investors closely monitor the market signals that Buffett's actions highlight.
Awareness of these indicators may be crucial for navigating potential economic downturns.
Today, we're discussing the alarming rise in auto layoffs, with 165,000 workers affected, and what that means for the car market.
Mitch Vexler emphasizes the potential buying opportunities in the auto market amidst these layoffs.
Mitch Vexler points out that the auto industry is facing massive layoffs and a significant shift towards automation.
He notes how consumer purchasing power is pressured as new car prices remain high, complicating market dynamics.
Mitch highlights that used car prices are experiencing significant drops, providing an optimistic outlook for shoppers.
Indeed, lower prices mean consumers can negotiate better deals.
Mitch suggests that new car prices will likely drop as inventory levels increase.
The presence of strong incentives from dealerships indicates a shift in the new car market.
Mitch warns against future auto bailouts, stressing that taxpayers should not bear the burden.
He reminds consumers to be cautious about financial commitments given rising automotive debt.
Mitch indicates that as supply rises and demand wanes, buyers can anticipate attractive deals in the auto market.
He suggests that consumers might find better prices by waiting to make their purchases.
Mitch advises consumers to hold off on purchasing until prices stabilize.
He highlights that options like car auctions could lead to significant savings.
Welcome back to Trade Brigade. Today's focus is on the market reaction to the PCE inflation report, which is critical for trading strategies.
The analysts discussed the bearish trends for technology stocks following the PCE data release, which suggests market volatility may increase.
The PCE data is the Fed's preferred measure of inflation. What are the implications for traders?
Analysts highlight a strong correlation between rising inflation and potential market corrections.
What are the analysts saying about technology stocks like Nvidia?
Analysts point out that Nvidia faced an 11% drop following negative earnings results, indicating a challenging outlook.
How does rising inflation affect trading decisions?
Experts indicate high inflation typically leads to market volatility, urging traders to be vigilant.
What scenarios do analysts anticipate after the inflation report?
Predictions suggest sustained volatility with possibilities of deeper market corrections.
What strategies do our analysts recommend as we approach today's market?
Patience and caution are vital. Traders should wait for confirmation signals at critical levels before acting.
In today's video, we analyze the recent patterns emerging in European banks, as examined by the founder of Eurodollar University.
The founder pointed out the concerning bond buying trend among European banks, coinciding with their notable cuts in lending to the real economy.
The expert notes that European banks have ramped up their government bond acquisitions this year.
In contrast, lending to the real economy has seen minimal growth, reflecting a lack of confidence in an economic rebound. The expert highlights that European banks accumulated €304 billion in government bonds in just 1 year.
This trend illustrates a heightened sense of defensiveness regarding economic conditions. At the same time, loans directed at households and non-financial corporations displayed minimal growth.
This stark dichotomy raises alarms about the trajectory of economic recovery.
The expert foresees that these defensive banking attitudes will persist into 2025.
Additionally, the anticipated stimulative effects of lower interest rates may not materialize.
In conclusion, the founder stresses that central banks might find it difficult to alter this course.
Investors are urged to maintain vigilance and adapt to a financial landscape increasingly characterized by risk aversion.
Today, we're diving into the housing market trends as Chris and I explore the latest data.
Despite declining mortgage rates, Chris notes that housing demand has flattened, which is an unexpected development.
Chris points out that mortgage rates have gone down significantly, yet there's no expected rise in housing demand.
Indeed, recent data shows that mortgage applications for purchasing homes are flat, raising concerns about buyer sentiment.
Chris highlights that the average 30-year mortgage rate decreased to 6.59%.
Yet, contrary to expectations, this decrease isn't resulting in increased demand as seen in prior years. Interestingly, refinance applications have dropped significantly, indicating hesitation among homeowners.
This could suggest many are still unsure about their financial situation in the current economy. Chris points out that consumer sentiment is trending downward, often leading to reduced demand.
This shift raises concerns about the housing market's stability as economic indicators fluctuate.
What does this signify for the housing market's future?
If trends of declining demand alongside decreasing rates persist, a market correction may be on the horizon.
It's important for potential buyers to stay informed about these trends.
Chris emphasizes that understanding the interplay between mortgage rates and demand is essential for making smart decisions in today's market.
Today, we're taking a closer look at the insights from Brian of the Technical Traders regarding some critical market signals.
Brian highlights significant volatility in the equity markets, particularly through the lens of the Russell 2000's recent performance.
Brian warns that the Russell 2000 may be forming a bearish double top, which could signal a significant correction.
David adds that Brian's analysis reflects a wider market sentiment shift, with increasing fears leading to sell-offs.
How does Brian analyze recent sell-offs affecting major indices like the S&P 500?
Brian explains that the sell-off in the S&P 500 has been substantial, indicating potential for further downside as the market establishes new support levels. Brian elaborates that NVIDIA specifically is showing significant weakness, which could further drag down the Nasdaq.
Indeed, the overall pressure in the semiconductor sector is a red flag for investors. What are Brian's predictions regarding potential market corrections?
Brian predicts the market might see corrections of around 20% if current trends continue, advising caution for investors.
What does Brian foresee for the next few months in terms of market movements?
According to Brian, we should brace for continued near-term volatility, with potential corrections that may weaken investor confidence.
In conclusion, Brian recommends that investors remain vigilant and adaptable to the changing market environment.
He emphasizes that adapting strategies based on market signals can help mitigate risks and capitalize on future opportunities.
What an intriguing wrap-up we've had. Each expert presented a wealth of insights.
Definitely. Brian's take on the Russell 2000's potential double top, that's a crucial warning.
Absolutely. And then Chris threw in that eye-opening perspective on the housing market. Falling mortgage rates, but no demand? That's wild.
Right? It raises so many questions about consumer sentiment and the market's next moves.
And let's not forget the Eurodollar University founder, pointing out that defensive stance of banks with lower interest rates was an eye-opener.
Exactly. It really shows how intertwined these issues are. Layoffs in the auto sector caught my attention too.
Mitch's insights about navigating those price shifts will be crucial for consumers. Timely advice.
There's a lot for our viewers to consider. And remember, not everyone agrees on the severity of these concerns, like Buffett's bearish hints.
If you found today's discussions enlightening, please give us a thumbs up, subscribe, and hit that notification bell.
Your support helps us continue to bring you expert analyses and insights. Don't miss out.
Stay tuned for our next episode, where we'll dive deeper into the global impacts on trade and economic growth. You won't want to miss it.